Morning everyone, and welcome to another RF Crypto video. As you probably know, the crypto markets aren't doing very well. The markets are in a freefall. We're basically in the midst of a bear market, which might be the worst bear market we've ever experienced because the prices basically halved and they continue falling with no stop in sight. And with everything happening in the world and with everything happening in the crypto industry, I don't see how we're going to recover from this in the short term. It's going to be a lot of pain. It's still going to be a lot of losses that people are going to bear. The markets are going to tumble even further, I believe, before we can start seeing any positive results. As you can see here, the global crypto market cap is below $1 trillion. Just imagine, it's below $1 trillion. A couple of months ago, it was close to 3 trillion, and now it's only 30% of what it was then. The price of Bitcoin, which was at once $69,000, is now at $22,000. Ethereum, which was close to 4,000, is now at 1,200. Cardano is almost going below half a dollar. Dogecoin, which was at almost 0.3, is now at 0.05. So we are in a bear market, and a very painful one. The bear market had already started. However, the fact that the price of Bitcoin went down by almost 30% and the global crypto market cap also decreased by almost 30% since last week indicates that the bear market is getting worse, and I don't know when we're going to see the bottom of it because it just seems to be decreasing more and more. The fear and greed index is extremely low, lowest it's been in a long time, and we're seeing a lot of pain in the market. Now let's talk about one of the best DeFi lending platforms which has crashed, and it has caused the global crypto market to crash even further. It led to a contagion which caused the prices to go down below 25,000, closer to 20,000. And this DeFi lending platform is Celsius. So this lending platform announced on the 12th of June, which is 2 days ago, that it was suspending all withdrawals on its lending platform, which cited extreme market conditions, and they said that they want to stabilize liquidity. However, Celsius is known as one of the safest and best performing crypto lending platforms, led by one of the best teams, backed by venture capital firms, backed by a lot of big people in the industry. So it is seen as safe, it is seen as reliable, and it is seen as one of the companies that will do well once regulations are in place. So being a lending platform, once regulations are finalized and there's a framework in place, Celsius is well posed to become a leader in that sub-industry of crypto. So after these extreme market conditions and a need to stabilize liquidity, Celsius's native token CEL plummeted by 70% in 1 hour, so that 70% of its whole value shunted in an hour. And the following day, it was trading over 40% down. So this downward spiral of Celsius came amid a giant sell-off that saw crypto's total market cap plunge to less than $1 trillion, like we saw before. So Celsius is a typical DeFi platform. It enables borrowing and lending of money. Anyone can just hop on and borrow and lend money. However, if they're interested in borrowing money, the loan needs to be over-collateralized. What that means is that the borrower has to deposit more than they're borrowing. So if they're borrowing $100 worth of crypto, they have to deposit $110. This sounds quite counterintuitive, but crypto is very unregulated, so there are no debt collectors to keep borrowings from defaulting. So companies like Celsius are actually smart in asking more than they're lending because then they can recover their losses if the borrowers cannot pay back their loan. Once users put money into the platform in order to borrow money, they're able to earn attractive yields. They offer 7% returns on stablecoins, 6% on Ethereum, and 6.25% for Bitcoin. So these are very attractive yields. You know that you borrowed crypto from them and that your collateral is earning interest while you're using the money that you borrowed. And once you pay back the loan and you get your collateral back, you get it with interest. And a lot of people are attracted to this simply because 7.25% is a very attractive yield for a stablecoin. If you go to a bank and you go to deposit money for, let's say, a fixed deposit or savings account, you'll be lucky if you get 1%. So 7.25% is incredible. So Celsius, how they're able to make their money is they then take that money and then loan it out at higher rates to borrowers. So let's say that they get 10% of interest. They pay you 7%. They're making a 3% profit. Even if they're making a 3% profit, you're still benefiting a lot because you're getting 7% instead of 1% that you would get in a bank. So where did the trouble start with Celsius? The cause basically is due to Lido's staked Ether, which is a token that's pegged to Ethereum's Ether token. So staked Ether represents Ether that's locked on the Ethereum 2.0 beacon chain, which is basically a chain that runs parallel to the main Ethereum blockchain, which will eventually combine with the Ethereum mainnet in an event known as the merge, which is basically a long-awaited event which will cause the Ethereum network to shift from a proof-of-work consensus, which uses a lot of electricity, to a proof-of-stake consensus, which uses very, very little electricity. And a lot of people are excited about this merge. So basically how staked Ether works is that on DeFi platforms, it is used as a collateral to borrow Ether. The problem is that staked Ether recently lost its peg to Ethereum, threatening those positions, with holders selling and the date of merge mired in uncertainty, which means that a lot of people aren't trusting Ethereum at the moment because they keep on postponing this merge. There is now heavy selling pressure on staked Ether. So staked Ether has already depegged from Ethereum, and now there's further selling pressure that will cause its price to plummet even further. So how does this relate to Ethereum? The DeFi platform had locked customer funds into staked Ether, and a staked Ether depegging could prompt a wave of redemptions, sparking a liquidity crisis. So if it prompts a wave of redemption, they won't have enough liquidity to pay everyone out, just like a bank run. And what happens then is that they can go bankrupt, they can go insolvent. And that's why they have halted withdrawals to prevent this sort of crypto bank run. And this is basically the reason why Celsius has lost so much of its market cap, its price has plummeted, and it's now halted its withdrawals. So Celsius is now feeling the heat. It's not the first time that it had problems, although the problems weren't as extensive as this. In the past years, several regulators have made it clear that they view high-yield crypto lending products such as Celsius as unregistered securities, which have a high tax burden. By last September, 4 US states had sent Celsius cease and desist letters for them to stop these high-yield crypto lending products and stick to the lower-yield ones. And in the same month, Coinbase shuttered its own planned lend product, which is similar to Celsius's high-yield lending products, after the SEC threatened legal action if it launched. And in May 2022, which is a month ago, Celsius changed its reward offerings to comply with regulators by phasing out high-interest accounts for non-accredited US investors. It's essentially a fancy way of saying that it had prohibited people who neither make $200,000 annually or have $1 million in the bank account from earning the highest yields. So they didn't stop these high-yield lending products completely. They just made it for accredited investors because they knew that they could pay it back for sure. And troubles for Celsius happened last month after the collapse of UST and its company Terra. A lot of people lost trust in the crypto market and these DeFi lending platforms because a lot of UST was put into Celsius in order to earn high yields, and those got wiped out. So a lot of money has been moving out of Celsius because of this decrease in interest and lack of trust. In the first half of 2022, the total amount of digital assets locked on the protocol shrank from about 24 billion to 12 billion, which is half, which decreased its liquidity pool and has basically contributed to the problems that are happening now. Now we have this issue where staked Ether has depegged and we're facing sort of like a bank run. And the fact that their total assets locked decreased by half a month ago means that they won't have enough liquidity to pay everyone out in case they need their money back. So that's it for today's video. Thank you very much for watching. If you enjoyed the video, please leave a like, hit the subscribe button, and share this video with your family and friends. Invest wisely, keep your heads up, and cheers.